good afternoon. Happy Friday, February 25th. Mark Milam here, your mortgage professional with Highland Mortgage, coming to you with this week's interest rate summary and market update. Boy, not even a war can really change the trajectory of mortgage interest rates, at least not all that much. And of course, we've seen a war now break out, for lack of a better word, in Europe. We know what's happening between Russia and the Ukraine, and one of the largest military actions we've seen certainly since World War II in that area of the world. And it's concerning, and typically what we would anticipate with an event like that is it's going to push money out of stocks into bonds. We certainly saw the stock market take a beating here in the last couple of days of this week and push that money into bonds. And we would think that we would see this nice improvement in mortgage interest rates with the flight to bonds, the safe haven of bonds, mortgages simply being long-term bonds. Well, we certainly stopped the bleeding in terms of how bad rates were getting, but we really haven't seen the bounce we thought we would get. And this is just such an indication that all that really matters is inflation. And inflation's still running quite hot, over 300% of the Fed's target range. Let's take a look at mortgage-backed securities while we're talking about this. Red days are bad days, meaning the value of the securities dropping, interest rates going up, green days vice versa. Of course, we had a holiday on Monday, so everybody was closed for the federal holiday. This is Tuesday. Did not do well on Tuesday, did not do well on Wednesday. Then war breaks out between Wednesday and Thursday. A little bit of a recovery on Thursday. Today, rather flat. And you can see we're not even finishing out the week where we started it. We lost so much ground on Tuesday and Wednesday that we really have not substantively recovered. And for that reason, most rates are about 1/8 of a point worse as we close out this week than as we began it. One bit of news that's important to note is that pending home sales decreased 5.7% in January. This comes against an expectation that pending home sales would go up by 1%. I'm not sure who came up with the idea that pending home sales would be going up at this point in time. There's such an inventory problem all across metropolitan areas around the country. And right here in Metro Atlanta, inventory down to less than 1 month, which is really the strongest seller's market that I've seen in my career. I've been doing this about 17 or 18 years. So pending home sales missing by that degree, such an indication of what's happening with inventory. And as inventory declines like this, we're going to see home price appreciation continue to percolate. And with home price appreciation where it is, 20% year over year as measured in January, we also have interest rates going up. Interest rates increasing by about 25 to 30% year over year. So you're really seeing this affordability, crucial moment for American home buyers, for people who are trying to qualify for mortgages. You've got home prices going up substantially, you've got interest rates going up substantially, and just not enough homes out there. One other article I want to show you comes, let's see, I think it's the National Association of Realtors posted their information here. Record low inventory driving it prices up. We see 22.3% drop in inventory year over year. We know that home price appreciation's been around 20%. And then if you take a look over here at Redfin, just getting some general information, we see 855 homes sold in the last 30 days. That's a decline of 13.9%. Average days on market right at 35 days. That's a drop of 15 days year over year. And the median sales price up to $390,000. That's a 20% increase year over year. So all signs point to decreased affordability. All signs point to the fact that not even a war can reverse the trend for mortgage interest rates. At least we're holding steady, holding our plateau for the time being, but it will all be about inflation as we move through the spring. Anticipate that next month in March the 16th, the Fed is going to raise the Fed funds rate. But now with the military action that's broken out in Eastern Europe, we might anticipate that the Fed is going to shift, and instead of raising rates by 0.5 point, maybe just 1/4 point, as we monitor the impact that the economic sanctions on Russia, that the global military event is going to have on our economy. More to come on that. It certainly will be an interesting weekend and week to come. If I can be of any service to you, don't hesitate to reach out. Mark.Milam at HighlandMTG.com. Thanks.